Yeah.
Hey, everybody. Welcome to the morning market briefing, Thursday, April 14th, 2022. A couple announcements. We're in a different place. Logan Rogan, as we call him, Joe Logan, he hooked us up with a little studio space. We're going to be doing the morning calls for the most part from in here. The hope is that the sound quality is better. There's apparently people that listen to the podcast, so shout out to those people. Hopefully this helps, and hopefully we can have a little bit more dialogue. Let's open up there. Tom, how's it going, man?
I'm doing well. Just excited to be here. Thanks for having me.
Ben, you pumped? Big show.
Yeah, we got a lot to talk about.
So let's jump in. Starting off with a Russia update. Norway and Sweden are applying for NATO membership. Russia is trying to prep for a major assault in eastern Ukraine. Ben, talk to us about kind of these ramifications. I think the tendency sometimes is to get fatigue on stories like this as they drag on and on and on. How would you kind of assess the state of play right now?
Yeah, so what happened was Emmanuel Macron, he apparently had some conversations or some intelligence, and he believes that Russia is planning a major assault in eastern Ukraine to essentially declare some sort of victory by May 9th. May 9th marks the anniversary of Nazi Germany's defeat in World War II. Moscow typically holds a large annual military parade that day. So that's kind of what's going on with that. And I think a lot of people are concerned that this is pretty much the calm before the storm. On top of that, Norway and Sweden both just applied for NATO membership or looking to apply for NATO membership. And that is not going down well in Russia. And they're talking about putting nuclear arms in the Baltic Sea as kind of a preemptive defense. So it seems like the Russia situation could ramp up again. We're not seeing that happen at the present time, but it does seem like the pieces are being moved on the chessboard in order to facilitate something like that.
Yeah, I feel like one of the weirder things in this whole saga is just the sensitivity to specific dates that we're seeing from Russia, concerns about the timing of the Olympics, certain anniversary dates on May 9th. It's just, I don't know, Tom, I feel like if I was running a war, I wouldn't be that focused on the calendar.
Yeah, I think it kind of shows just where Putin's probably at, where he's just sort of he's got an axe to grind, and so he's being very symbolic about it, particularly with the dates. But I think what this is, in my mind, is almost like if you get in a bar fight against a guy you thought is smaller than you, and he starts beating you up, then you pull out your knife, and I think that's what's kind of going on here. He feels threatened, and so you got to rattle the sword a little bit.
Meanwhile, Zelensky says he needs $7 billion a month, basically an immediate financing need as he tries to cover social payments and salaries, et cetera. So tough situation as Zelensky and Ukraine try to continue to hang tough. Moving it more domestically, we got economic data coming out right now. Retail sales will set the tone for expectations, and then we'll get the reading. The headline expectation was for growth of 0.6%, excluding autos. The expectation was plus 1%, excluding autos and gas. Expectation to be up 0.2%. Where'd we come in, guys?
Yeah, we came in a little bit, pretty much in line with those expectations. What I think actually is encouraging, though, is we did get an upward revision for February. So although the March change versus February is about what it was, the February baseline is a lot higher than we initially thought. So I think overall that's a pretty good sign for where first quarter GDP is. Right now, the estimate for first quarter GDP is in that 1 to 1.5% range. And I think this could pop you up to 1.5 to 2% range. And that comes despite Omicron and despite the war. And so what you're seeing basically is that the economy continued to trundle ahead in the first quarter. The question is, where does it go now? And that's something that we continue to evaluate. We talked about it at the macro presentation. But right now, it looks like the economy is moving forward pretty well, and initial jobless claims continue to be very low.
The number that's jumping out to me, aside obviously from the upward revision for last month, is that the ex-auto number is actually higher than expectations. So even with the pullback in used car sales in terms of the pricing there, you're still seeing an advancement of the retail ex-auto, which I think is very positive as well.
Awesome. Interesting stuff on the rate side, Tom. I want to throw it to you for a little bit to talk about what's going on with the ECB. And also curious, just kind of your take on an interesting way in which we could see interest rates remain inverted for some time or retrace that inversion that we saw a couple weeks ago.
Yeah, so there's a couple of moving parts. So yesterday was really unusual in terms of the rate move. So we had the very hawkish statements from Jim Bullard in the morning, which should have pushed rates up. We had the banner number and PPI, which should have pushed rates up. And then additionally, we had a pretty soft 30-year Treasury auction in the afternoon that was kind of a disappointment. And the number of foreign buyers had dropped by about 7% month over month in terms of Treasury issuance. All of those things are pretty net negative for the bond market. And we saw a massive buying across the board. Even after the bad auction on the 30-year, we ultimately ended up lower on the 30-year Treasury than that auction went off. So those people made money right away. In terms of the ECB, they basically have made a slightly more hawkish stance, which is, they've begun their tapering, and Christine Lagarde essentially said that they're continuing to push that forward. And the expectation is that they will probably finish faster than they thought they would. Initially, they thought they were going to finish their taper in the third quarter, but it appears that's going to wrap up a little bit more sooner. So that's a net hawkish move for the ECB. And additionally, they said they're going to target raising rates after they finish their taper. So that could happen sooner rather than later as well. And so if Europe jumps in on the hiking stance, if we get a number of additional hikes, suddenly we're going to see a lot of pressure on the short end of the yield curve, both domestically and worldwide, which I think is going to be, it could potentially push us back into inversion, which is that there's going to be a lot of push up on the front end and maybe perhaps not so much on the long end. Though I would say that one counter argument for that is that we saw a massive step up in the 30-year mortgage rates yesterday. We popped up way over 5 for the first time all the way back since 2010. And so we're definitely seeing, some different moves in the bond market that may be counterintuitive to what everyone's thinking, which is that we're going to have a flat yield curve. We're going to see a lot of inversion, but we're starting to get a little bit steeper, and we're particularly getting very steep on mortgage rates.
Yeah, I wanted to ask you about the mortgage rate thing. We talked about that at length in the macro presentation, which is now up on the blog, both in video and just PowerPoint form. Are you surprised, knowing what we know, are you surprised that 30-year mortgage rates have climbed so much? Because I'm a little bit surprised they've moved that much that quickly.
I mean, yeah, for context, for those who weren't in the macro presentation, that day, the 30-year mortgage was about 475. And the following morning, we pushed up all the way up to 514, 515 on a 30-year mortgage, which is a massive move. I mean, that's huge day over day. And so they're moving a lot more quickly than I thought. I still had the expectation that if we continue to see rate hikes and we continue to see things move the way they're moving, that 6% is not out of the question for the year, but it's definitely a potential that could happen a lot more quickly, or we may push up very quickly and then kind of drift back down before taking another leg up.
Tom, how much do you think that is due to people who would typically invest in mortgages, just saying, what, I am not going to fight the Fed here. I know the Fed is potentially going to sell mortgages. So not only have you taken out that demand from the market, but you've actually increased the supply of mortgages, and people might just be going on a buyer's strike on mortgages, which is just accelerating that. And until it's almost a chicken or egg thing, until mortgage rates start going down, they're not going to go down. Does that make sense?
Absolutely.
And once they come down, because we've not only seen the 30-year go up, but we've also seen spreads widen with mortgages, and that needs to compress.
Yeah, I would definitely agree. I mean, I wouldn't touch mortgages right now with a 10-foot pole. The reason being, we know that mortgage rates are going up. So if you buy, say a mortgage bond, even if it's a new issue and it's paying you 5%, which would be exceptionally high for the last 10 years, we have a fair expectation that by the end of the year, they're going to be at 6%. And so if you're buying a 5% mortgage, you're going to get what's called extension risk, which means those people who are in those 5% mortgages are not in a hurry to pay them back more quickly because, either through refinancing or for selling their house and buying a new house, they're going to have to reinvest that money into a higher mortgage, which slows the transition of moving between houses. Like, I probably am stuck in my house for a long time now because I would have to basically double the cost of living to move into a different house, even if it was the same price. And so, I'm not going to be attacking my mortgage as aggressively as I used to, because whoever's holding that bond is taking a bath every single day as rates go higher. So I think there's just nobody out there who's like, man, I just really want to jump in on these 3% mortgages from last year, because they're going to be losing. I mean, you could lose 5% a day. I mean, I'm sure yesterday people took a massive haircut on their short or on their lower coupon mortgage-backed securities.
They're not going to drop. until they drop. Wisdom from Ben. Elon Musk has made an offer to buy Twitter, pretty nice premium relative to the price prior to the announcement. This is being positioned as his best and final offer. Ben, we've said we'd keep an eye on this story. It's been relatively volatile. He took on the big stake, said he wanted to be on the board, then said he wasn't going to be on the board. We kind of felt, I feel like we touched on this Monday a little bit, that, maybe his next move is to actually take over the company. If this isn't accepted, where does he go from here?
I think if it's not accepted, I think he just exits the stock, and probably tries to do something of his own, or I don't know what he would do, but I think that he's always wanted to just control Twitter himself. He wants to buy it and then just keep it private, and make the changes internally as a private company, and that's what he would do with it. So I think that it is an interesting deal. It would be about $40 to $50 billion. I think the premium is reasonable. I don't think this is Elon Musk coming out with something that's 5% higher than the current stock price. This is a legitimate offer that he's making. It's all cash. I just don't know if the Twitter board's going to go along with it.
Yeah, I'd be shocked if they did. I don't know if you have anything, Tom.
I love the move on his part. I think it's an awesome way to flex if you got that kind of money and that kind of conviction on what you want to do with that money. At the same time, it's almost reminiscent of when he jumped in heavy on Bitcoin, bought $1 billion of Bitcoin for Tesla. Everyone's like, oh man, Elon Musk is lending Bitcoin credence. The price went way up. And then we saw him go, oh, never mind. He sold out of it, made $1 billion. Tesla had a nice, print on their balance sheet, and he moved on. And that's possible that he could be doing that here. He could make a very easy buck selling that 10%, a lot higher than he bought it, and then just move on.
Yeah, it'll be interesting to see how he plays it out. I mean, I don't know that he loses, kind of to your point, Tom. I don't know that he loses if they don't accept the offer, but it'll be interesting to see. Super jam-packed day today. We've hit economic data. Just for a quick kind of status report on futures, that kind of thing. We've seen a little bit of strengthening on S&P and NASDAQ futures, which were down a little bit and have moved essentially to flat. Dow futures are up 12 basis points. None of that's very noteworthy. I do think it's going to be an interesting day. Last trading day of the week. Tomorrow is a stock market holiday. Again, no call tomorrow because of that. But we not only have economic data, but we're really ramping up into earnings season. Ben, we've heard from Taiwan Semiconductor. We've heard from Wells Fargo, Goldman, Citi, Morgan Stanley, United Health, a number of companies. Take us on a little bit of a tour of what you're seeing. It's early, but sometimes we look really heavily to the banks as something as a read through on what's going on economically. What are key takeaways?
Yeah, so just starting with the banks, I think the big takeaway is the banks really don't know too much what's going on. They posted pretty good numbers this quarter, but that was largely due to really good trading revenue. So basically acting as the intermediary for, especially on the fixed income side, they performed generally fairly well on the fixed income. That really drove the numbers in the quarter. In terms of the core banking business, I think they're generally optimistic, but they're very concerned with inflation and kind of what we were talking about at the macro presentation. The impact of inflation and the shift from quantitative easing to quantitative tightening, and in such a rapid manner. Jamie Dimon was talking about it yesterday, talking about how the results would be volatile. So the companies that perform in that volatility are also performing right now. So if you look at Goldman Sachs, a company like that, where volatility is its friend, does well, and a company like Wells Fargo, where volatility is not its friend, does less well. And we're seeing that play out. And so it's not really surprising that we're seeing Wells Fargo.
And I think also operationally, when we think of the best operators in the banking space, it's not necessarily surprising, regardless of the source of the volatility, that maybe Goldman's up 2% and Wells is down 3% after earnings.
Right. And I think that's a little bit of a departure from what it was even in the December quarter, where Goldman was warning a little bit that, and we were thinking that this may be peak profits for Goldman as things normalize a little bit, and it could be the beginning of a better period for Wells Fargo. But instead, we had Q1 where we had more volatility and things kind of reversed back a little bit. And it's really kind of the COVID playbook, is what did well and what held up in COVID. Held up in Q1, and what didn't do well during COVID fell in that quarter. We can talk a little bit about Taiwan Semiconductor. Taiwan Semiconductor, interestingly, actually raised guidance for the year pretty nicely. I mean, they're expecting revenue to be up probably close to 30% or maybe even above that for the year. They're doing so at really good gross margins. One of the things they did note, though, is that what's really driving the business is high performance computing, even more than smartphones. Smartphones and PCs, they do expect to take a little bit of a step back here into Q2 and Q3. That's notable. It will have an impact on other semiconductor companies that sell into those smartphones and PCs. But in terms of high performance computing, NVIDIA uses Taiwan Semi to make a lot of its chips for that. That should continue to do well, and that should continue to support the semiconductor industry over the next number of years, including this year.
What's interesting with them, you may be looking at it, you see the numbers, and it seemed like a very strong quarter with a pretty clear explanation for the numbers. It's only up about 1.5%, 2% pre-market, but that comes on the heels of being up more than 4% yesterday. So, you're looking at a stock that's up more than 6% since we opened yesterday. So some of that potentially baked in. We certainly saw some things ramp up yesterday.
And I think people are becoming a little bit more calmer with the inventory levels that are rising in the semiconductor supply chain. What's happened is that inventory levels have risen in the supply chain because a lot of companies are still concerned about being able to get that supply. And you're also seeing pockets of demand, pockets of areas of strength and pockets of areas of softening. I don't want to be too aggressive on the softening because we don't really know too much about what's going on the smartphone side, but it is definitely weaker than what we're seeing in the more kind of high performance computing, the data center, that sort of thing.
Lastly, United Health, they've got their conference call starting about 2 minutes ago, so we're late. A little bit surprising that they didn't raise guidance a little bit more, although I do feel like that's somewhat consistent with what we've seen from them over the past couple of years. Obviously, a monster in the healthcare and insurance space. They've continually operated pretty well, but I feel like they've been erring on the side of conservatism as it relates to any prognostications they're making.
Yeah, I think it's a flight to safety asset at this point in time. It's an oligopoly. They're going to hit the numbers and they're going to raise guidance every quarter. I thought they could have raised it by more this quarter, but what happens every year is in the fourth quarter, you adjust your reserves and you tend to have a big reserve release or reserve build in the fourth quarter, which really boosts earnings per share. And I expect that to happen again. The one thing I would say on United Health is they performed really well on the Medicare business, and actually Medicaid was actually up as well, which is kind of surprising given the increase in employment and fall off in initial jobless claims. But commercial insurance was actually down on a quarter-over-quarter basis. I was thinking that we might actually have a little bit more of an improvement in the commercial side. They've really focused on the retirement sector and on Medicare. And I think that's notable. And I think they've taken a lot of market share there from Humana. So I think that this is not a United Health wins, all the other insurers win scenario. I think it's a United Health wins at the expense of some of the others.
Yeah, I agree. We'll wrap it up there. Appreciate y'all for being with us. Hopefully you could hear us. Maybe you could see us. That doesn't really matter. We will be back on Monday. There's no call tomorrow. The stock market is closed. So we will not have a whole lot to chat about. So we're just not going to do it. But we'll be back Monday at 8:30. We'll continue doing the daily calls. We'll just be doing a whole lot of them from in here. Hope you guys have a great long weekend if you're off tomorrow, a great regular weekend if you're not. Happy Easter, all that good stuff. And we'll talk to you guys soon.